A very good evening, friends. I'm Sanjeev Singhal, Central Council member and Chairman, Auditing and Assurance Standard Board on my own behalf and on behalf of my Vice Chairman, C. Vishal Bhai Doshi ji. I welcome you all to this 91st program of AASB for this council year. So it's about 3.5 months. And in 3.5 months, it is 91st program and 43,000 members have already been benefited from these programs. We have organized these programs again on wide spectrum of the topics covering audit, and today's webinar is on audit expectation gap. Friends, we will soon be also coming out with a series for the young speakers, where maybe that those members who have become member in the last 5 years, we'll be inviting them to speak, to moderate. The idea being that to encourage the new generation to audit, because we have seen that most of the members who have recently qualified, they join the industry, and very few members are joining the audit profession. So to encourage the young speakers for the audit related subject, we'll be coming out with a separate series. This series will continue as it is. And let me also tell you that from 17th April, our helpline on audit related queries is already running on for the audit of the corporates as well as the non-corporates. And this will go on up to 30th of September. Please feel free to ask your questions. There is no fee for it, and the turnaround time is 24 hours to 48 hours. We have about 50 experts who are responding to the queries, and this may be treated as the world's largest helpline on audit matters. There are about 30 lakh entities. So the auditors of all those entities are free to ask audit related queries from our experts. Don't think of the bandwidth of the expert. We have enough experts. If more experts need to be added, we will add those. And friends, today, this topic, audit expectation. In fact, if you really see in this month journal, also I've authored an article on expectation gap. Because the society feels that the auditor has all the responsibility. The regulator feels that an auditor is a bloodhound. Whereas, the auditing standard says an auditor is a watchdog. So there's a huge expectation gap. The society expects that the auditor will be able to unearth everything possible or everything, and nothing should remain unearthed after his audit report has been released. Whereas the fact is that auditor works within a given time frame, within a given scope. So it is very important to address this expectation gap. It is very important to communicate to the society, to the regulators, what is the role of the auditor. We have done program on this topic earlier also, but this is one topic which needs to be highlighted again and again. Hence, we are, bringing this topic again before all of you. And I have the extreme pleasure in welcoming my very good friend and a very renowned member of our profession, CA, Anil Bhai Sharma ji. Anil ji has been a member of NACAS and now is a member of NFRA. So I had the privilege of sharing both NACAS as well as NFRA forum with Anil Bhai. Anil Bhai is in practice for last 4 decades. He's a senior member of Messrs. A. Sharma and Company, based at Delhi. And, he's an adjunct faculty within the Institute of Corporate Affairs. And he's been a member of the Expert Advisory Committee of the Institute of Company Secretary also. He's been a co-opted member on so many committees of the ICAI. And, he is also an expert with various groups within the issue. Recently, we worked on capital reserve, the treatment of capital reserve, and Anil Bhai was a member of that. Anil Bhai is also a non-executive independent. He has been a non-executive independent director to UCO Bank from 2016 to 2019. He was also a special invitee to the revision for the Caro group that was undertaken. And very fine human being, dedicates himself to the social cause also. And so many forums you will see Anil Bhai contributing. And it's really a matter of indeed privilege and pride that Anil Bhai takes out time for the professional as well as social activities. So thank you, Anil Bhai, and I would request you to kindly deliberate on the topic.
Yeah, thank you very much, Sanjeev ji. And in fact, let me congratulate you and along with you the board for the work which you are carrying on. In fact, when we talk about audit expectation gap, the kind of work which you are doing, you just mentioned that 91 such programs has already been organized in just 3.5 months period. It's really, you are really doing something to bridge that particular expectation gap. And in fact, if you look at the good reports which has come up on these particular topic, they have very specifically mentioned about training and education of professionals. So from that point of view, I really congratulate you, and I hope you will keep this work going. So coming to the topic, see, as Sanjeev has rightly mentioned, it's a very important topic. So I have a presentation, so I will take you along with that presentation, and maybe since we have sufficient time with us, if you can raise questions in between, I would be pleased to answer, or if you want me to answer all the questions at the end of the deliberation, that is also okay with me.
So I would request Anil Lalji to take up the question as and when he's receiving the questions and the comfort of Anil.
That would be very good. Yeah. Let me share my screen. Okay. So the agenda of my today's presentation, I would be touching upon 4 areas. First, let us discuss what is audit expectation gap. Then, as we talk about expectation gap, then we are talking about expectations of the users. Who are those users, and what auditors report, and what are the gaps? Then what has been done to fill the gaps so far, and what can be done further? I think I feel that we can discuss this particular spread of this topic. This would be good enough. So starting with the very first point, see, as and when we have seen these corporate failures, and especially without any warning signals, and scandals across the globe, every time a question comes up whether auditors has done their duty with regard to expressing their opinion, and with regard to highlighting issues relating to going concern, as well as in the fraud in their while executing their audits. On the other side, auditors of these corporate entities are always claiming that they have expressed their opinion after duly complying with all accounting and auditing standards. You see, in the recent past, if you look at some of the major scandals, I mean, there's no need to mention all those, you all know that, but it is happening across the globe. In India, we have, like in 2018, we have ILFS, Nirav Modi. And 2019, I mean, these are just few which I'm just mentioning. Then we have CG Power and DHFL. And 2020, you can see Yes Bank, and now even Carvey Stockbroking. And similarly, in other parts of the world, Carry Leon, UK, Luckin Coffee, China, Wirecard, Germany. These are some of the very see, talked about see, corporate failures and frauds, which has been now being debated. And if you just try to see what were the issues there, it could be seen that there were diversion of funds, there was siphoning of funds, there were overstatement of income, there were overstatement of expenses, and in some of the cases there were issues of non-existence of assets. So how come these types of issues are not detected by the auditors, and they have not they couldn't see it, which ultimately resulted in either corporate failures, or where these scandals has really been exposed later at a later stage, when some other agencies, adjudicating agencies, were brought into the picture. So these events have highlighted a continuing expectation gap, a difference between what users expect from an auditor and the reality of what an audit is. So it's very interesting that that this is not a new phenomena. I mean, expectation gap we are discussing this issue for the last 50 years. And if you really see that the earliest reference of this word expectation gap, you see this was there in 1974, when a paper was published by Carl Gigio, who was then general counsel of Arthur Young and Company. And at that time, he used this word expectation gap. See how he defined it. Just look at the words. He said the difference between the levels of expected performance as envisioned by the independent accountant and by the user of financial statement. So expected levels of expected performance. So that difference. So he took he defined expectation gap with these words. After that, so many other definitions have been followed. In 1993, another research paper which was published by M. Jennings. So in his research paper, he defined audit expectation gap as the difference between what the public expects from the auditing profession and what the profession actually provides. These words are important because these are going to, you see, when we will further analyze and dissect these definitions, only then we would be able to see some kind of a solution there. Association of Chartered Certified Accountants, ACCA, they have also defined the expectation gap. And in fact, they have broadened this term by defining it as the difference between what the general public thinks auditors do and what the general public would like auditors to do. See, what it is the difference between these two things, what public thinks auditors do. So they have some expectation, they expect that auditors would be doing that. But what general public would like auditors to do, that difference has been defined as audit expectation gap by ACCA. Now, let us first look at who are the users of general purpose audited financial statements. I'm sure all of you are well aware of this aspect. There are both existing and prospective investors. They would be interested in looking at those audited accounts. Lenders, suppliers of goods and services, employees, and in addition to that, another set of users are regulators, market regulators, or and then revenue authorities are also looking at, and then other stakeholders. Other stakeholders, for example, it can be general public also. For example, very good example can be, you see, like these days, CSR is a very important head which is coming up. So there, a general public is also looking at the financial statement, whether the company has properly spent the amount which is required to spend on corporate social responsibility. So these are, and if you can look at, analyze that each user has his own angle. He expects information from audited financial statement from a very specific and his personal or own point of view also. Sorry, I don't know what is happening here. So if we, after looking at these users, if we go further, then as today we are in a age which is which we call it information age. Information is all over the places. If you go look at the internet, you find everywhere different type of information. And similarly, what information is coming, shareholders and other stakeholders are also worried or rather concerned whether the information which is being communicated by the directors, can they trust that information? And for that purpose, they are looking at auditors. They feel that auditors are in a very unique position because they have a right to look into and go deep into the all the working of the company, and they have access to all the information. So therefore they are the one who can really in a position to provide that kind of trust on what directors are communicating. So the public sees audit as part of a solution to unacceptable corporate behavior, making sure financial give a holistic true and fair view. And stakeholders are expecting from us means from auditors. And let us look at the other side, what we are reporting. So auditors are, see, if you look at our reporting standards, which are SA 700, revised SA 705 and SA 706. And if you look at the structure of our reporting, auditors report, so first we express our opinion, and then we also give the basis of that opinion. Very specifically it is mentioned what are the responsibilities of the management with regard to financial statements, and what are the responsibility of the auditors for the audit of financial statements. And then of course we also report on various legal and regulatory requirements also in our report. So the report is very well structured, responsibilities are well defined, and if you look at the opinion para also, there also all kinds of words are used to the best of our information and according to the expression given to us. These are the words when we express our opinion, these are being used. The financial statement give the information required by the law in the manner so required. So it means we are expressing our opinion that financial statement provide that information which is required by the law and in the manner so required by the law, and give a true and fair view. Again, true and fair view is also like a attached with the words in conformity with the accounting principles generally accepted in India. So in spite of so much clarity and with specific words in our auditor's report, still the impression being carried by some of the users is that something more is required from the auditors of the company. And in fact, if we look at the two paras which I just mentioned about management responsibility para, there again very, very clearly it is mentioned that how financial statement has been prepared by following accounting standard by the management. It is their responsibility. They are responsible to maintain adequate account record and safeguarding the assets. They are the one who have to ensure that there is a prevention and detection of frauds and irregularities. They are there to make reasonable estimates. They have to maintain adequate internal control system, and they are the one who have to assess company's ability to continue as going concern. So primarily all these aspects are very clearly mentioned, that these aspects are the responsibility of the management. And in auditor's responsibility para, again, look at some of the very forceful words which are being used are reasonable assurance, free from material misstatement, and examination on test basis, and audit conducted in accordance with specified standards prescribed under section 143(10) of the Companies Act. So everything is well within the framework, well, and all kinds of I won't say the restrictions, but the scope, the reasonable assurance, material misstatement, and examination on test basis. And this is based on this, we have done our audit and have expressed our opinion on the true and fair view. So we thought that with this, we are very clear from our side what we are actually delivering. But again, as I mentioned, that this issue is that their expectations are much more than what we are doing. In fact, I would like to draw your attention to standard on auditing SA 200. As you have seen that we have very clearly mentioned that audit has been conducted in accordance with specified standard prescribed under section 143(10). And if you look at SA 200, which is the overall objective of the independent auditor and the conduct of an audit in accordance with standard of auditing, para 5 is so clear. It says that the reasonable assurance is not an absolute level of assurance, because there are inherent limitations of an audit which result in most of the audit evidence on which the auditor draws conclusions and bases the auditor's opinion being persuasive rather than conclusive. So when we say that we followed standards on auditing, so para 5 gives that kind of background. When we say reasonable assurance, what does it mean? How our opinion is persuasive rather than conclusive. And similarly, if you go further in SA 200 itself, in para A45, para A45 deals with inherent limitation of an audit. It very clearly see, mentions there that auditor is not expected to and cannot reduce audit risks to zero. So, and cannot therefore obtain absolute assurance that the financial statements are free from material misstatement due to fraud or error. This is because there are inherent limitations of an audit, which is resulting most of the audit evidence on which the audit draws conclusion being persuasive rather than inconclusive. Same one again, because so we have heard what this para is very particularly talking about, that cannot reduce audit risks to zero and therefore cannot obtain absolute assurance that the financial statements are free. So that's why we say that reasonable assurance. So in spite of so much clarity so far as auditors are concerned in their auditing standard, still there are allegations that in hiding behind the need only to confirm and verify, many auditors have failed to grasp the opportunity to make their reports more informative. And see, the second part is very interesting. So there are, in fact, it is being asked that auditors, when they are communicating with the audit committee or with the board of directors, they are actually communicating well beyond the narrow confines of audit standards, auditing standards. But when it comes to shareholder or other stakeholder, they are not that much informative or that much open. So this is one, allegation which we could see, which is there. I'm so sorry. What is happening? So this leads us to a situation where we have to think, do we have to really redefine audit? So what has to be done so that this kind of expectation gap is taken care of? So can we look at another set of authorities or institutions, especially those who are doing the they are into the government audits, international standards of supreme audit institutions, which are doing audit of government companies, government organizations, and ministries. So there, if you look at their standards, which is series 100 to 400, there what they have done, they have defined audit in a different manner. They say that audit includes financial audit, proprietary audit, and performance audit. Financial audit is fine. We all are aware of this. But what is the proprietary audit? Proprietary audit is directed towards examining the propriety of executive action beyond the formality of expenditure to its wisdom, faithfulness, and economy, and bringing to the notice cases of waste, losses, and extravagant expenditure. So, number of times when we go into the financial audit, we can easily say that expenditure was incurred, there is a proper documentation, supports are there, all the internal control with regard to verification of expenses and approvals, and everything has been taken care of, and it has been. But was that expenditure resulting into getting the same kind of return which it should, which is it expected to be? So it means, was there those expenditure overstated? So wastage, losses, extravagant expenditure, these are some of the angles which proprietary audit looks at. So I think I personally feel that in financial audit, this aspect is also a important aspect, and maybe we have to bring it that also. And similarly, about the performance audit, what and very basic questions performance auditor uh, gives: are things being done in the right way? Or, and the second question is, are the right things being done? So very interesting words to explain what performance audit is all about. So performance audit is an independent assessment or examination of the extent to which an organization, programs or schemes operates economically, efficiently, and effectively. So all the three aspects, economy, efficiency, and effectiveness, these are this become part and parcel of the performance audit. And try to visualize a situation where both proprietary and performance audit aspects are built into the financial audit, and then maybe some of these questions which are being raised by the users of the audited financial statement may be addressed. Now let us look at some of the steps which has been taken to bridge this, or rather to close this expectation gap in audit. Number of moves have happened, and in 2019, ACCA, in fact, they come out with a publication, and the title of that publication was Closing the Expectation Gap in Audit. And in fact, they, while addressing to the issue of expectation gap in audit, they described three components of expectation gap: the knowledge gap, performance gap, and evolution gap. What are these three? Let's quickly look at that. So knowledge gap has been explained as the difference between what the public thinks auditor do and what auditors actually do. So very interesting, knowledge gap. This recognizes that the public may misunderstood the role of auditors and the requirements of the auditing standard. I would say that most of the earlier definitions were definitions of expectation gap was defining this term around this knowledge gap. And what is the performance gap? Where auditors do not do what auditing standards or regulations require due to the complexity of certain auditing standard, or sometimes auditors do not understand, they are not very clear what is the requirement, and then they underperform on those aspects, or sometimes differences in interpretation of auditing standard or regulatory requirements between practitioners and regulators. This has also come up very well in, if you look at some of the recent orders passed by NFRA. So you can see that there is a interpretational issue. Difference are coming where practitioners are defining some of the language of standard on auditing in a different way than the the NAFRA is defining those requirements. So that can also lead to gap in the performance, and therefore called is performance gap. Evolution gap is a one step further on that issue. Areas of audit where there is a need for evolution, taking into consideration the general public's demand, technological advances, and how the overall audit process could be enhanced to add more value. See, as we can see today with the use of technology and technology not only in manufacturing, delivery of goods, so many in the entire economic activities, things are changing. So whether audit is also changing accordingly. So audit process also has to upgrade themselves and to address that whatever new things are happening in due to technological advance in the economic world, they also have updated knowledge or processes to address those aspects. So this is a evolution gap which has been, so these three types of gap which has been identified by, and accordingly in their paper they have suggested how to do that. Now on the similar lines, International Audit and Assurance Standard Board has also started discussion in September 2020. So they were, since so many questions were being asked about auditors' role with respect to fraud and going concern in various audits of a financial statement. So they started this process of gathering information so that they can determine what are the new projects which they can take up, or what are the new standards on auditing they can bring in, or changes they can make into those standards. So for that purpose, they, in fact, in that paper, they floated two questions and invited responses on a lot of questions, but two important ones which were addressing directly to the expectation gap. So first question was, what do you think is the main cause of the expectation gap relating to fraud and going concern in an audit of financial statement? So it's a simple one. So what do you expect? What do you, as per your opinion, what is the main cause of this expectation gap? And then taking the cue from ACCA discussion, they raised the second question, whether main cause includes a misunderstanding of the role of auditors, unclarity or inconsistency, applied requirement, which is the performance gap. First was the knowledge gap, or the need for enhancement of to add more value, evolution gap. So whether main cause includes a misunderstanding of the role of auditors. So they are trying to ask that which one of these three is best, and which has resulted in expectation gap. So this was the question which was being raised, and I'll show you some slides which will bring forth a picture how different stakeholders, whether they were regulators, whether they were auditing setters, standard setters, or whether they were users, look at their responses, and then you will find. So what I'm trying to place before you is that still so much confusion is there, so much confusion. What is expectation gap? But actually it is, unless we know the cause of expectation gap, it is difficult to address that. So just quickly give you 4 or 5 responses which IAASB received, and the first one was from International Organization of Security Commission, IOSCS. So what they say that in our view there is an overlap between the knowledge and evolution gap in terms of financial statement users expectation of audit. So here they are talking about knowledge and evolution. So they are not talking about the performance at this stage. This relates not only what auditors' current responsibilities are today based upon the existing standards, but what the users expect they should be. So it means this clearly giving a direction that something has to be done with the standards. These standards must address what users are expecting from auditors of this of the companies in their reports. Now, second is from FRC, which is Financial Reporting Council. Now, what their response was onto those 2 questions. Different stakeholders may have different views as to how they would wish audit to evolve and the level of assurance they want their audit to provide. While audit inspections and investigations are into corporate failures and major frauds have revealed audit performance failures and inconsistency of application, there is no evidence of general performance failure in all audits. So in light of this, we would not suggest that from a global perspective, there is one particular main cause of an expectation gap. So, so you can see here that they are saying everything is okay. It depends on auditor to auditor. Some auditors have faltered and therefore all this has happened. Otherwise, other 2 things, which is the knowledge and the evolution gap, they are not commenting on that. They are only talking about the performance gap. So that was their response. Third one is International Federation of Accountants, IFAC. So what IFAC is saying, we agree that some users of financial statement and other stakeholders may misunderstood the role of auditors and the requirements of ISAs in relation to others in financial reporting ecosystem. So role of auditors, as there are a number of stakeholders, they are saying it is understandable. In addition, there can be a lack of understanding that management and those charged with the governance has the prime responsibility for the prevention and reduction of fraud and assessing the entity's ability to continue as a going concern. So since these questions were primarily on to the 2 aspects, which was the going concern and the fraud, so they are saying that there is a lack of understanding that management have the prime responsibility. The thing which I was just referring you in the main report, it was very clearly mentioned what are the responsibilities of the management. So IFAC is saying that the stakeholders have not understood that aspect very well. So, and goes further, it says one of the factors contributing to the expectation gap is the failure to understand the situation auditors face in reporting on matters such as going concern in the absence of adequate reporting to investors and employees by directors, which may also lead to calls by auditors to address issues that are unreasonable. Again, I would say IFAC is very much in support of the auditors. They are saying auditors are not in a better position to really report on matters such as the going concern. because they are the adequate reporting to investors as per the requirement of the standards as or the statute uh, are not there so much. So therefore, uh, since it is not the requirement, therefore auditors also do not report. That is also resulting into see expectation gap. So that gives an indication that maybe some specific reporting requirement on going concern may be there. I mean, a very good example is that we have seen in recently when we amended our CARO reporting, a special reference, maybe not fully to the going concern, but at least to one part of the going concern was required to be very specifically reported by the auditors of the company. We'll come to that. I would be taking up at an appropriate time. Center for Audit Quality, what they have to say? Center for Audit Quality, they say we believe that knowledge gap or the difference between what the public thinks auditor do and what auditors actually do with respect to fraud and going concern is the component that is most often responsible for the expectation gap. So they are very clear that knowledge gap is the main thing which is resulting into expectation gap. And with respect to going concern, we believe that in addition to the knowledge gap, the evolution gap also contributes to the expectation gap. Considering the related accounting auditing standard together with the modernization of business and users' need would address the evaluation gap. So I think this point was raised, was explained by me earlier also, that evolution gap is definitely an area which users require that to be addressed, whereas at the moment our accounting and auditing standards require little bit some more amendment on that aspect, so that this the reports and financial statements are addressing the needs of the users in the when this modernization of business is happening. So definitely evolution gap is also. So from Center for Quality, Audit Quality point of view, see knowledge gap and evolution gap are to be addressed. Coming to the next one, which is the this Confederation of Indian Industry. Now look at the industry side. They are also users of the financial statement. They are preparing it, and then they are user also. So what they have to say on these two expectation gap relating to going concern, they say that there is a clearly an increasing expectation among stakeholders, a higher level of assurance on the absence of material misstatement due to fraud than has been historically proved and accepted. So material misstatement, and with respect to there is something, material misstatement has to be redefined, and that fraud aspect has to be realigned when we talk about material misstatement. Rapid development in technology and availability of signal and data enable all to better meet those expectations. So again, evolution gap we are talking about. In many corporate failures, fraud has led to concealment of factors that may lead to challenge of the going concern assumption. In our view, this does not reflect on adequacy of the auditing standard on going concern, but more on audit procedures addressing the risk of fraud. So here again, you can see that there is a direct indication that the knowledge gap they are expecting. What they are suggesting is auditing standards are on, especially on the going concern, are fine, but audit procedures which are addressing the risk of fraud, there is some scope for further improvement. But a very interesting and very different type of comment was received from the committee of UK Parliament. This is called the Business, Energy and Industrial Strategy Committee. I have just taken the word from their see what they have to say. He said, we were both surprised and disappointed to hear the view from audit firms that because fraud is difficult to detect, the public should not expect auditors to find it. I mean, when we say that why we could not detect, it is the responsibility of the management to detect fraud. So this committee was, they were not satisfied, or they were not satisfied with the auditor's explanation that should not expect auditors to find detect fraud. We do not accept the attempt of auditors to underplay the role or scope of audit, nor to implicitly blame the public for failing to understand the purpose of audit. I mean, since they are politicians, so you can expect this kind of very, very harsh language which they have used. They are saying, don't blame public that they have not understood, in spite of the fact that you have written so many ifs and buts, and then we're giving the report. That is not, from their point of view, it is not a good, so we are underplaying the role of or scope of audit. Rather, the firm should focus on the poor quality of their audits and on how they are falling short of what audits are for within the current framework. So this is we should take this as a very constructive criticism and go further on this. Now let us look at some of the recent steps which has been taken to bridge the expectation gap. So first, let us take the Companies Act. I mean, if you look at section 143, subsection 3, 9, 11, and 12. Subsection 3, there are some other matters which has to be included in the report. Subsection 9 talks about we have to comply with auditing standards. Subsection 11 is some additional matter which government may prescribe in the consultation with NAFRA, which comes in the shape of companies auditors report orders. At the moment, we are following 2020, and reporting of fraud under subsection 12. If there is any fraud by the officers and employees of the company on the company, then and it comes to the knowledge to the auditor, then they are duty bound to inform to the central government under subsection. So that is one aspect of bridging the expectation gap. Similarly, if you look at some of the amendments which came through LODR, which are issued in terms of SEBI Act. So very specifically, two regulations I would like to highlight here. The first one is Regulation 30, which talks about resignation by statutory auditors of listed entities or its material subsidiaries. Because you see, this is again a very interesting amendment which came up in LODR in 2019. What was happening that in some of the cases, statutory auditors were resigning, knowing that there were some problems but they don't want to. They avoid reporting that in their reports. So therefore, government has see no other way but to bring in this regulation 30, where they say that in the case auditor is resigning, he has to give the reasons for that. And see, if it is in between they are resigning, then at least they have to complete one assignment, which is suppose they are doing a quarterly audits. If they have already done first quarter and then they are resigning, then they have to complete second quarter. And if they have done 3 quarters and then they are resigning, then they have to do fourth quarter as well as the full year, and only then their resignation would be effective. And similarly, they have to give a very detailed reasons and which are to be disclosed by the company after taking that information from the auditor. And there is a specific annexure which is attached to this particular regulation 30, and very detailed reasons, because sometimes these reasons will bring in the issue which was actually there. Resignation may be simply a tip of the iceberg. Inside there may be a lot of reasons which may lead to some indication of frauds and issues with regard to going concern also. Similarly, regulation 33, which is onto the financial results. In the case of a unaudited quarterly results, which are then there is since those are unaudited, but through this regulation, a limited review process has been brought in. So now it's quite an old provision now, and there is a prescribed format report in which the limited review auditor has to give his report. Similarly, if in the case of a final audit, if there is any qualification in the auditor's report, then this report will also accompany with a statement from the management, which will be statement of impact of audit qualification. Then they have to really explain that how this auditor's qualification are going to impact on the true and fair view of the state of affairs as well as results of the reporting entity. So I would say these are two important areas which are changes which has been brought in to bridge the expectation gap. Since we mentioned about section subsection 11 in section 143 and subsection 9 also, a lot of changes has happened in the reporting standards also. From 1st April 2018, if you look at all the 3 reporting standards, SA 700, 705, and 706, all the 3 standards has been revised, and not only revised but even new standard SA 701, which is key audit matters, has been introduced. You see, the idea of bringing this key audit matters was to give more and more transparency into the auditing process. What were those areas which were identified by the auditors as important, as key areas, and how they have handled it, how they have taken care of those areas. Frankly speaking, if you ask me personally, this information is really very, very important, and gives the insight of the audit. Even if the auditor's report is unmodified or there's a clean report, still you can, through this information which is coming through SA 701, you can understand what were the technicalities, or what were the major areas which required auditors' attention, and how auditors have handled it. That is really a very useful information which is now coming to the stakeholders, and definitely will result into bridging that kind of expectation gap. Now, if you, since I mentioned about revision of all the 3 reporting standards, so now if you look at the revised structure of our auditor's report, you can see here opinion, then reasons for opinion. Now CAM has come into, then other information, SA 720. This is something again very important, because when a stakeholders look at a report of a company, then he along with the financial statement, he also looks into other documents, which may be director's report, and so many other annexures to the director's report, in terms of Companies Act, as well as in terms of LODR requirements. So sometimes it has been seen, a lot of confusion happened. What is the information which has been given in the director's report, and that information may not be matching with the financial information which is coming from the financial statement which has been audited by the auditors. So therefore, a duty has been cast upon through SA 720 on the auditors to really look into other information also, which is going along with the financial statement to the stakeholders, whether there is any variation, difference, or any other manipulation in that information, and auditors are required to report that in their main report itself. Similarly, SA 570, since going concern was one of the major concern relating to expectation gap, because a lot of companies without any warning signal, they collapsed, and then maybe later on auditors revised their reports and came out with the revised reports that new information has come to their knowledge, and they are withdrawing the new report and all that. But just to take care of that particular aspect, SA 570 revised on going concern, very specifically on that, auditor is also now making a comment in the main report. And of course, the earlier part of categorically making a distinction between what are the responsibilities of the management and what are the responsibilities of the auditor. Another way to I would say that section 143 subsection 11 is a unique tool with our regulatory with the government, where they can go beyond the reporting requirement as envisaged or as are there in the reporting standards and all that. It is a unique piece of legislation in our Companies Act, and very large number of additional information is coming from the auditors to the stakeholders, which is definitely a very, very big additional information, which is and very useful information, which is coming to the stakeholders, right from MAU Caro to then to Caro, and now Caro 2016, and then moving to Caro 2020. You can see how, first let us look at Caro 2016, what are the new reporting requirements which was brought in, and which is and then see, you have to look at, the stakeholders has to look at this additional reporting requirement from this point of view, that this is an effort by the regulator, by the government, to provide additional information which otherwise they were not getting from their main report of the auditors. But this is coming from the auditors' mouth, from their they have to verify. In some of the cases it is statement of facts, and some of the cases where they are expressing their opinion also. So it's a mixture of those type of points. For example, if you look at in Caro 2016, whether the title deed of real properties are held in the name of the company, if not, provide the details thereof. This was a very important information because in some of the cases when it was, and some of them are knee-jerk reaction also. When something happens and some issue emerges, those are also addressed. So in some cases, it was found that properties of the company were not held in the name of their, in the company itself. So though all payments were made by them. So from that point of view, this categorical statement, whether the title deeds of immovable property are held in the name of the company, is important. Similarly, whether the company has granted loans, secured, unsecured, to companies, LLPs and other parties which are covered in 189, of course, it has now been changed. Whether the terms and conditions of grant of such loans are not prejudicial to the interest of the company's interest, because a lot of issue of diversion of fund was there. So to address that issue, this type of reporting requirement was brought in respect of loans, investment, guarantees and securities, whether provision of 185 and 186 has been complied with. Again, same. Whether money raised by way of initial public offer or further public offer and terms loan were applied for the purposes for which those were raised. So this again important information, and diversion of funds happens and then these are to be reported by the auditors specifically under Caro. Some more are whether any fraud by the company or any fraud on the company by its officer employee have been noticed or reported during the year. If yes, then auditors are required to very specific comment on the fraud itself. Whether related party transaction, then whether they have been complied, the legal requirement has been complied with, and whether disclosure requirements as per the accounting standards have been complied with. Specific comment on that, and any non-cash transaction with the directors of the company, holding company, subsidiary, associates, and compliance of section 192, where non-cash transaction, the director, so that this siphoning of funds doesn't happen. So this type of reporting requirement was brought in. But and then when you go to Caro 2020, a massive exercise was done, and a lot of new reporting requirement was brought in. We can quickly classify these reporting requirements into four broad areas. One on the ground, on the going concern, second on the fraud, and third providing a lot of information to bankers and financial institutions, and fourth category can be on specific regulators. I'm talking about some additional reporting requirement which has been brought through Caro 2020 as against Caro 2016. Looking at the first set of enhanced reporting on going concern, whether short-term funds used for long-term uses, cash losses incurred during the current year and immediately preceding year, comment on existence of material uncertainty in company's ability to meet its liabilities existing on the balance sheet date and due within 1 year period thereafter. We have always, auditors have always been shying away with the reporting specifically on the going concern, but you can see this, that this time they have to, of course, lot of basis has been given. They have been provided with information of reliability of receivables, and the extent of trade payables, and the various ratios which management has calculated and provided them. And they have also access to a lot of management information on the future businesses of the company. And accordingly, based on that, now they have to give this particular comment. Of course, it is not onto the overall going concern, but at least onto the current liabilities part, which are due in the next 1 year, that the company is in a position to. So I would say that liquidity aspect comment is very much there in this. So it is again a very, I would say, important information coming to the stakeholders from the auditors through CARO 2020. On to the fraud, revaluation of property, plant and equipment, and involvement of registered valuer. I mean, this provision is purely addressing to the fraud. Number of times it has been used that companies have used revaluation through unscrupulous valuers, and took a lot of bank funding from institutions and banks, and they defrauded with that money. So this is a good addition. Term loans applied for purposes other than for which they were taken. Evergreening of loans now clauses. Loans and advances in the loan granted which are repayable on demand. So whether they are prejudicial to the interest of the company. The internal audit system commensurate with the size and nature of business. Reporting of fraud under section 143.12. 143.12 otherwise requires auditors to report, but now auditors has to bring into the CARO report whether any such reporting has happened during the year under audit. And of course, the whistleblowers complaint, how they have been addressed by the auditors, that is also required to, how they have been addressed by the company, that is also is to be given by the auditors in their CARO report. Specifically to the banks and institutions, some useful reporting requirement, the coverage and procedures of physical verification inventory. Earlier, it was only with regard to the maintenance of record of inventory, but now the physical verification, the coverage and procedures, how it has been done, and whether it, to what extent it has been done, and who were involved, all those are physical verification inventory has become. And because number of times all cash credit limits which are there on security of inventory, their level of security depends on the coverage and procedure of physical verification. Similarly, working capital limits, which has been sanctioned on the basis of security of current assets, whether the returns which has been filed are in line with or are telling with the information in the books. So auditors are now required to give, and if there is a difference, then difference has to be explained. Funds obtained to meet the obligation of its subsidiary, associate, and joint ventures. Raising loans on the security held in subsidiary and associates, and whether the company has been declared as willful defaulter. These are some very, very useful information now coming to the stakeholders, which are banks and financial institutions of the companies through these specific references. Similarly, to reporting on Benami, holding any Benami proceedings carrying on or has been launched against the company for holding any property under Benami Transaction Prohibition Act. Then non-cash transaction, I think this was already there. The resignation order and issue involved in it. surrender made before tax authorities, and whether that has been, if there is any adjustment required in books of account, has that been done in the year of surrender. All those are some important information which is going to different regulators from this CARO 2020. So you can see that at least from government point of view, a lot of efforts has been done to bridge the gap. So they have brought in some amendments in the act, in the statutes, whether Companies Act or LODR, and then they have also brought in a lot of changes in amendment in reporting under CARO, and which is in terms of section 143.11 of the Companies Act. And this way, they have brought in a lot of information coming from auditors for different type of users for their specific uses also. Okay, now what has been done and what we have seen now, let me take you through a very interesting case study. Though it is not very much onto the audit expectation gap, but when you go through the order which has been passed, a very interesting mention of audit expectation gaps are there. So that's why I have selected this particular case study. Now, this is a recent order which has been passed by NFRA under section 132(4) of the Companies Act 2013 in the case of CA Som Prakash Agarwal. The order was passed on 12th of September 2022. The facts of the case was that Vikas WSP Limited was a listed company. This company was classified as NPA by the lender banks, and this company did not recognize the interest expense on its borrowing from banks in its statement of profit and loss account for 2019-20. So, which resulted in overstatement of profit by the company by that much amount, which was PBT was 19.2 crores and interest understated was 16.91 crores. So you can see the impact. Had this interest of 16 crores have been provided in the books of accounts, profit would have been reduced to hardly 2 point something crores. So that was the highlight or the issue in this case. The company statutory auditors were S. Prakash Agarwal and Company, and CS Som Prakash Agarwal was the engagement partner. Firm has given a unmodified opinion, which means they have given a clean report. And NAFRA charged the engagement partner with professional misconduct on various grounds. And what are those grounds? Two important grounds were that management of VWL accounted for interest accrued on such loans classified as NPA in financial year 18-19, but did not do so in 19-20, thereby deviating from their own accounting policy. Despite such inconsistency, the EP did not report about the same during the audit. So this was one ground of charging him for professional misconduct. And second was absence of audit documentation for non-recognition of interest cost on borrowing classified as NPA by the lending banks. Absence of documentation challenged the management for such erroneous accounting treatment. So this charge was, the background of this charge is that when all the information and working papers were asked by the NAFRA from the firm, so they could locate that there was no document where the engagement partner or the firm has has asked any information from the company, why they have not provided for such information, why they have not provided for interest on NPA, which is the contractual liability, and all that. So in response to that, if you look at the arguments which has been given by the engagement partners, these are very interesting arguments. First of all, the auditor said that he has complied with auditing standard, and he said that and must not be understood in isolation with understanding that auditing standards notified by the government are a set of principles to follow for audit, and those principles provided enough room for exercising auditor's judgment and for adoption of alternative processes. Therefore, prescription of auditing standards are not thumb rules. Now, this is a stand which auditors were taking in this particular case, that auditing standards are not thumb rules. They are principles and have ample scope for the auditors to exercise auditor's judgment. The second argument which was given by them was the respondent had exercised his judgment to the fact of the case. The company was offered a one-time settlement proposal by the lender bank, and accordingly OTS proposal, the company estimated no extra outflow beyond the carrying value. Since the company was following Ind AS, following the effective interest system to be followed for interest accounting, no amount of interest was due to be recognized. So that is the argument which they are saying, that since there was offer of one-time settlement, though nothing concrete, or it has not been accepted, or nothing more has happened except the proposal, and therefore by applying Ind AS, since no further outflow was involved, therefore means that the likelihood was that in OTS no interest would be paid by the company. So therefore, they say that therefore no interest has not been recognized in the books of it. This is the argument which the EP has been taking. And third argument which is taking is that audit documentation is one of the means to the process of audit. What has to be tested is not the process, but the judgment itself. Judgment made by the respondent was not only based on working papers available in writing, but also based on output from several discussions with the company management, which is integral to forming an opinion. So his argument is that he discussed that with the management. Everything need not be documented. He is not supposed to scribble down all the discussions which has happened with the management, like taking minutes of all that. And it is in the normal process. He has discussed it, and this discussion is very well is part of the process of audit, and therefore he is not guilty of professional misconduct what is being charged. So this was the three basic arguments which he has given before the NAFRA. So now coming to the decision, I mean, of course, he was found guilty, and whatever decision NAFRA took, that is there in the judgment. You can look into that. But a relevant part, which I thought is very important from the topic which we are discussing today, I am presenting those two aspects before you. One was the extract from the decision, and which has been taken by the NAFRA, and the basis on which they have took the decision. Some extract of that. So I'm just reading that for you. The essays and Ind AS are mandatory for the preparer of accounts and the statutory auditors in preparation of audit and financial statement of listed entities. It is a flawed understanding of the EP when he speaks of auditing standard not being thumb rules, but a set of principles for audit, which allow auditors to adopt alternative processes. So now you can see here in these words a very clear-cut message that regulators are treating auditing standards as rules which has to be followed in line by line. And there is these are, so this is very important. I'm not commenting on whether who is correct, who is not correct. I'm simply talking about how this judgment resulted in the kind of penalty which was imposed and what is the basis. So they are saying that auditing standards are not being thumb rules. Second part is more important, and through this, NAFRA is not only giving a message to the specific chartered accountant who is involved into this particular case, but also to all auditing and accountancy professional. And look at the language which they have used. The EP does not understand that the present day standard setting has undergone a paradigm shift wherein sufficient application guidance and other explanatory materials available in SA and INDES apart from the principles of standard, which are required to be mandatorily followed. All auditing and accountancy professionals should be seized of this. So it's a clear-cut message to all of that. Us that whatever explanatory material and which is available, application guide and other aspects of that, and explanatory material, which is though sometime very specifically mentioned in the standard that it is not part of it, but they are saying that this has to be read along with the standard and has to be mandatorily followed. So this is one message I want to highlight from this order. Second message which is coming through NAFRA, through the order by NAFRA, is auditing financial statements are the basic input for innumerable transactions in the economy. A breakdown or severe damage to the trust and confidence that the public and investor have in financial statement would have ramifications that go far beyond the limited activities of the auditee company. So they are saying that simply breakdown or one audited financial statement, if there is any problem, it is not restricted to that company itself. It has a very vast and severe ramifications and can result into damage and breaking of trust and losing the confidence of the public and the investor into the entire economy. So they are trying to bring in this aspect, a very holistic aspect of the whole issue. And finally, one more message which is coming through the decision of this CA Som Prakash Agarwal case. Please go through this particular para word by word. An auditor has a societal mandate to provide an independent and true opinion on the financials of the entity audited by him, so as to inspire trust and confidence in the financial system. As professionals, auditors are expected to judge the significance of operation of the entity they audit and accordingly calibrate their approach and procedures. The auditor's duty to exercise due diligence is owed to the users of the financial statement. So look at the kind of message which is coming through this particular decision, and we are talking about expectation gap, and they are now, the NAFRA is again addressing to the same issue through this and warning the entire auditing community what is expected from them, and what they have to do. They have to calibrate their approach and procedures, and they have to stand to the expectation of the entire users of the financial statement, which ultimately has a direct impact on the financial system as a whole. So, and in this, in one more place, this is not part of the judgment, but I have I am quoting NAFRA chairperson, where he was speaking in a audit quality program which was relating to audit quality, and then he referred a interesting report by Bryden, Sir Bryden, and he mentioned that I tend to agree with the view mentioned in that report that the problem is not one of the expectations. Rather, we have a grave delivery gap when it comes to the audit. Now, straight away, the entire blame is coming onto the delivery gap, that auditors are not delivering what they are expected to deliver. So, quickly, let me, so it led me to go through the report of Sir Donald Bryden also. So that's a very interesting report. And in fact, it is indicating some of the areas which are the action point for the profession, as well as for the regulators to address, to fill this expectation gap. First of all, this report was given by Sir Bryden to the Secretary of State for Business, Energy and Industrial Strategy, which is a parliamentary body in UK. And they have been asked to give suggestions after taking consultation with the stakeholders and experts and users. And in fact, before that, there were two earlier reports also. One was in 2018. This was an independent review of the Financial Reporting Council by Sir John Kingman. And the second was Statutory Audit Services Market Study by Competition and Market Authority, CMA. This was in April 2019. So you can see that December 2018, April 2019, and immediately thereafter in December 2019, there are three such reports which are available, and which have been addressing to the issue of expectation gap and and the quality of audit. Sorry. Yeah. So if we just try to summarize what this report recommends, which are relating to auditors. So I can safely bifurcate that into three aspects. One, what are the changes which they are suggesting in the audit report. Second is changes in the definition of professional judgment itself. And third is something about audit transparency. And these are very, very, I would say, interesting observations which has been made, and will give us a lot of material to think what can be, what is the way forward. First suggestion is onto the word true itself. There's Sir Dryden has given a lot of thrust on this word true. He's saying that most of the expectation gap is because of this word true. Though since the auditor is writing true and fair, and but actually looking into the other aspects of auditor's report, it is confusing to convey that whether it is true because of the other, see, ifs and buts which has been provided there. So here the Sir Dryden is suggesting that the term true and fair should be replaced with the term present fairly in all material respect, which I feel is a very good suggestion. Auditor's view on fair presentation should be informed by the new principle for audit profession, which includes acting in the public interest. You say that, okay, fine, but when we say fair and material, then we should also be considering as an auditor that we are acting in public interest. So how that will brought into our reporting aspect, or in our auditing aspect, that I think our professional bodies has to work on that and has to ensure that fair presentation word itself should convey to us that when we are saying fair presentation, we are acting in public interest. So present fairly in all material respect and bringing in public interest into the fair presentation of the fair presentation view by the auditors are two important changes in the which is suggested in the auditor report. Then another very interesting point which has been suggested is about the professional judgment, because when we talk about, say that how professional judgment has been taken by us, and we are talking about in our report also the about the reasonable assurance, and then talking about the basis of how we have took the professional judgment. So here again, a very interesting aspect is being suggested. It says that in addition to concept of professional skepticism, the need for professional suspicion is also brought into this professional judgment. Very interesting point. So at the moment, we always claim that we are only watchdogs and we are not bloodhound. But now I think this is a very good suggestion to suggest that our approach while taking a professional judgment, we have to have some professional suspicion also. So don't take this suspicion word in a very normal parlance. Professional suspicion is a word which has to be defined in a very professional way, that how a profession should consider a particular activity as suspicious activity, and then how he should be addressing to that situation and take the final professional judgment on that issue. I would say that very deep suggestion, and is definitely to be worked on. And so far as audit transparency is concerned, a suggestion has come up from Sir Donald Bryden in his report. He said that auditors should disclose, when they are disclosing the entire process, how they have done the audit, they should also disclose within the audit report the hours spent on each audit by each grade within the audit team. So it means then virtually they would be disclosing that what was the team which was involved in completing that audit, and what was the combination, the qualifications, and see the stature of those team consist of, and then how much time they have spent. So this is again a very interesting aspect of bringing in some audit transparency, which will give that definitely give a good input to the, when we can give CAM where issues are there, then we can also give this a timeline, how much time has been spent. In any case, this information is already being maintained by the auditors for each and every audit assignment which they carry out, where as a part of SQC they keep this record, how team has been built, looking into the specific requirement of the client, and accordingly how much time has been spent, how it has been reviewed. All those aspects are already there as part of audit papers. But now what is being suggested is at least give some disclosure on that aspect in the audit report also. Next suggestion. Other recommendations which this report has given, and I think we should consider when we are looking into addressing the bridging the expectation gap. One suggestion is facilitate direct approach by customers and suppliers to auditors. I mean, the way audit committee is can be approached by the whistleblower. Similarly, the report is suggesting, can there be some kind of mechanism where customers and suppliers can report to auditors, and then auditors take due recognition of their concerns, and accordingly pose question to the management and to the board if so required. Obligation to acknowledge external signals of concern. See, this is again a very important element which sometimes at present I would say that it has not been seen auditors following this. External signals of concern are the signals which are coming from the overall environment, business environment in the world, in the country, in that particular region where the company operates, and the general. For example, if we take the case of these days, because of climate change, because of war which is happening there, and because of so many other issues, businesses are affected, are going to be affected. So these are external signals. So how auditor, what it is trying to, report is trying to say that auditor should take recognition or acknowledge the external signal of concern, and he should be obliged to do that. I mean, it should be part of its duty to acknowledge that, and accordingly take suitable step in framing his opinion on true and fair or whatever views it is suggesting. And then the report is also suggesting that since fraud is one of the issues which is creating a lot of which is the reason for a lot of expectation gap. There should be some package of measures around fraud detection and prevention. So first of all, it has to be uh, brought in as part of auditors' responsibility, and then there should be some kind of a framework which is given to address this aspect of fraud detection and prevention. The report is quite open on this aspect, though this suggestion is there, but no specific package of measures has been suggested in the report. Auditors be required to undergo initial and ongoing periodic training in forensic auditing and fraud awareness. So instead of forensic auditors looking into the financial statement at a later stage when thing has already gone wrong, I think a very good suggestion in this report that auditors should themselves have a training in forensic audit and should apply the forensic accounting and auditing skills in his audit. Another very important recommendation, which you may or you may not agree at this stage, but it's very interesting suggestion which is coming up from that report. In fact, there are two such suggestions. The first one is auditing is too important to be left to an adjunct of another profession. It should be an independent profession in its own right, with its own governing principles, qualification, and standard. At present, it is extension of the accounting profession whose ethics and mindset it largely adopts. So I'm sure a lot of professionals amongst us, and especially from if we look at from institute point of view, we may not agree on this, but it's definitely a point to ponder that the DNA of a chartered accountant presently is largely of an accounting profession, and then it is extended to auditing profession. So can we think of this on these lines that there should be a altogether auditing and accounting profession should be a altogether different. These are not my words. These are recommendation by by Sir Donald Dryden in his report. Sorry. One more important point which he has mentioned in his report, and it is again I would say really worth looking at and should be acted upon. It is talking about the audit environment. It said that auditor interact with many participants, whether it is management, non-executive directors, standard setters, regulators, users of accounts, which are the shareholders and other stakeholders, who all need to play their part to create a fully functioning environment. One weak link can undermine all the others. To make the audit itself of a better quality and more effective, changes need to be made by those other actors also. It looks a very philosophical statement, but I think it is a actionable point from I am fully convinced that each one is required to act. They have to perform its duty and responsibility in the overall environment to make this entire audit environment a fruitful environment. And when we with this, I would like to conclude that we have to redefine audit process. That is the way forward by the auditor to inform as well to verify and confirm. I think what I'm trying to say that uh, going beyond the information contained in the statements of the director, we have to change this mindset. If this change in mindset comes, and then appropriate structures and principles are built, and then combined with more focused training and better user engagement, auditor can serve a much better useful purpose. So I would say that at the moment, audit is not dead. Audit is slightly deviated and requires some redefining and some modification, and which will become very useful and will serve the useful purpose. So thank you very much. I think we have still 10 minutes to answer the various questions.
Thank you so much, sir. Thank you, sir. Thank you so much for detailed deliberation on the topic. Sir, I have received certain questions.
Yeah, please.
Asking, as we all are aware that auditor is a watchdog, not a bloodhound, and the purpose of audit is not to catch to found only the fraud. It is to disclose whether the resources of the company judicially, transparently, commercially, and effectively managed or carried out with fear or favor.
Right. Right.
If it is so, why many corporate shortcomings are not exposed? Auditor is responsible for this, but why still we are having such shortcomings?
In fact, this question he should have raised in the beginning itself, because what we have discussed today, what I have deliberated today, is the entire gamut of this issue only.
Yes, yes.
Auditor feels that we are carrying out our responsibility of audit according to the as provided in standards on auditing, and we are doing our duty. Whereas the other side, the users are expecting more. So they are saying we want more from them. So, and then in that expectation gap, we have also seen that number of professional agencies and committees have identified that this gap is because of 3-4 issues. Sometimes it is performance gap, sometimes it is expectation, because of the evolution gap, that since the requirement is what they are demanding is more, and sometimes it is the knowledge gap. So what auditor is public thinks auditor do and what auditors actually do, that difference is also like is an issue. So how to address that? And then the point which he raised was that we are there to as a watchdog. So now I think if you look at some of the recent adjudicated cases, the message is quite clear that they want auditors' role to be more than of watchdog. They want some input of bloodhound also. That's why the concept like suspicion and concept like addressing the frauds are also now being debated, that it should be part of that. I think all the standard setters, regulators are already working on that, how to bring that into this audit aspect. So I think we should now stop using that word that we are watchdog and not a bloodhound. That statement is, I think, now obsolete and should not be used by us while explaining our responsibilities and duties. GNLG.
Sir, according to you, what is the major difference between expectation gap and perception gap? Kindly throw light on this, sir.
Exception and perception.
Yes.
Perception word I have not used. I have used three gaps. One is knowledge gap. The second is performance gap. And third is evolution gap.
Yes, sir.
Right. So perception, I don't think perception word is a appropriate word here. Expectation gap can be, so first of all, expectation gap is again a wider term. So when we have divided that into three aspects, so it means looking into all these three aspects can be considered as expectation gap. So knowledge gap is the difference between what the public thinks auditors do and what auditors actually do, right?
Yes.
मतलब हम क्या सोचते हैं कि एज ए पब्लिक हम सोचते हैं ऑडिटर ये करता है और ऑडिटर क्या एक्चुअली कर रहा है, और दूसरा है वेयर ऑडिटर्स डू नॉट डू व्हाट ऑडिट, ये हो गया परफॉर्मेंस गैप, जो हमें नहीं पता कि हम ठीक कर रहे हैं कि नहीं कर रहे हैं, हमें हमारे स्टैंडर्ड कुछ बोलते हैं पर हम उसको इंटरप्रेट किसी और तरह से कर रहे हैं, सो दैट इज द परफॉर्मेंस गैप. और थर्ड इज इवोल्यूशन गैप. द इन द चेंजिंग वर्ल्ड, इन द न्यू environment, technological advances, have we upgraded ourselves to address those technical advances and accordingly reported? So that's the another area which requires address. So from that point of view, these three gaps together are considered as expectation gaps.
Yes, yes. Sir, what is difference between internal audit and pre-audit?
Internal audit and pre-audit. Okay. So the internal audit, if you really ask me, internal audit is a management exercise. See, internal audit is actually part of internal control system. When a internal control system is set up by a company, then they would also install internal audit to ensure that internal control system is working and working effectively, and there is no area left which has not been where internal control is not there. So internal control verifies that, and therefore this is considered as a management exercise. So and if you look at the section also, it very clearly says that the internal audit, the scope of internal audit will be decided by the management and internal audit themselves. Within themselves, they will say, हमें क्या करना है, क्या नहीं करना. That is their. So it is purely a management exercise. But when we come to the pre-audit can be of two types. One, pre-audit when it is part of the internal control system itself. As you know that we always use this word maker-checker concept, which is very popular words which we use. When somebody is making and other is checking, and only after that some action is taken on that. So pre-audit is that maker-checker exercise. Somebody has, let's say somebody has prepared a voucher and the other has approved it, and after that payment has been made. A very simple example of pre-audit. It can be in all other areas also. So it is internal audit would look into pre-audit aspect, but pre-audit will not look into internal audit.
Yes, sir. Sir, in view of the audit expectation with relation to GST matters, and how to check evasion and fraud committed by the business entity in this regard?
See, expectation gap. Now, okay. Now let me mold this question in this way, that this is a expectation gap from regulator point of view. A regulator, which is, or rather, a revenue authorities, which is GST directorate, they want auditors to ensure that all the compliance of GST laws have been complied with by the company, right? So it means that auditor has to look into first the internal control system, how GST compliances has been ensured by the company that they have been complied with, and then he would, based on see all the see internal control checking when he does, then he would look into that aspect whether all systems are in place. For example, if we take whenever goods are sent, e-way bill is generated, and all of these are steps. So first he will see that the system is foolproof. It complies with all the GST requirement. Then he will test some data on that. Whatever his sample he will make, and then he will test. And after testing that data, he will say that, okay, system is now robust. It is as per the requirement. And based on that, whatever results are there, then those results are then would definitely be getting inbuilt into other financial aspects of the company. For example, into the bank account, into the sales, into the purchase, and so many other, into the inventory, into the other aspects. So from that point of view, GST, from the expectation gap point of view, it is the expectation of the revenue authorities, which is the indirect tax or GST authorities. They expect auditors to do everything, whereas auditor again take that plea that I am giving only a true and fair view. It's in generally material misstatement. I'm only looking at material misstatement. So any small error here and there, which is not material, I'm not supposed to report that. So that part may be a expectation gap from a GST point of view.
Yes, sir. So these were the questions for today's deliberation, sir. When I come to an end, sir, thank you so much for detailed deliberation on the topic. Hope our participants have gained a lot through your deliberation. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant, I extend my heartiest thanks towards you, sir, for sparing your valuable time and for such a wonderful and detailed deliberation, sir. Thank you so much, sir. Thank you, sir.
Thank you very much, and keep the good work going.
Thank you, sir. Thank you so much, sir. Thank you.